Hey guys, welcome back to the Value Investor Show. Today, I want to talk about a stock, a company that I invested heavily in. I have invested 18,000 in this company because Wall Street has been selling, because Wall Street doesn't understand the business. And today I want to unravel everything about this company. So the company is one that I have been talking about for a few weeks, for a few months, and that is Deckers Corporation. Deckers has been hammered the past few months and more so this past month. And for today, I want to go through my conviction, what my conviction says, my investment thesis, the valuation of the company as I see it, and where the stock goes from here. Deckers Corporation, for those that don't know, is a company that owns a few brands, but it's primarily based upon two main brands, and that is UGG and HOKA. The stock has been down 60% from its year high, which has been an all-time high for this company. This company was trading at $230 a few months ago, and is down 60% from that top and 57% down year to date. In fact, we've seen the lowest point this year at $79. We haven't seen these levels for 4 years. And since that low point, the company is now up at least 10% from that low and is now gaining momentum finally. After the longest time of being beaten down, it's now finally getting some momentum. And the company is still trading at a very low PE ratio. It's now trading at a 13 PE ratio at 13 billion market cap, and I believe that this company is significantly undervalued, mispriced, and most of all, it's misunderstood by Wall Street and investors. This year, I bought a few stocks that have been heavily hated by Wall Street. I've covered them on this channel, yet these same stocks have rebounded heavily. One of them was Google. I bought Google for the first time in my portfolio in April. I felt like there was so much hate around Google being replaced by AI, and the fundamentals just didn't make sense. The current pricing of Google at that point in time didn't make sense. And since my investment in April, I'm now 105% up on my Google investment. That's a gain of 15% per month just on Google. Now, another stock that I was talking about, a company that I was talking about, was United Health Group. I bought United Health for the first time in July and August when the stock was going crazy. Everyone was selling. No one wanted to buy this company, especially after the second quarter earnings. And I was posting about it. I was still positive. I knew that there is still a lot of problems with United Health, but I was posting about it. I was buying it. And since then, the company has been on a roll. It's now almost 20 to 30% up from my original investment. And I feel like there is another company that has very similar characteristics, and that is Deckers, because it feels like Deckers could be the third stock in a row, the third company in a row for me this year that is just misunderstood. Now let's go into Deckers. Deckers, as I said, is primarily based on two brands. The first one is HOKA, and as someone who looks at companies as not only as an investor, but also as a consumer to really understand how their business model works, and also if I am a consumer, would I buy this company? And the truth is, for HOKA, I have the shoes, I believe in the brand, I love my HOKAs, and more and more people are actually wearing HOKAs. I see them everywhere, and now they're shifting trends, because people are not only wearing HOKAs for running, they're also wearing HOKAs as an everyday shoe, as a gym shoe. And I see HOKAs more and more in gyms that I didn't used to see back a year ago, for example. Now, one of the things that I like about HOKA and the management is that HOKA has been taking a regional approach in marketing. As you can see, these are some of the accounts created by HOKA and are being followed by HOKA, which are targeting specific regions and based on the region, based on the trends on each region, they're trying to create a targeted audience approach. And also, these are some of the regions that HOKA is growing the most, because in Asia Pacific, for example, HOKA is showing extremely healthy growth levels. We're talking 20 to 30% year-on-year growth compared to, for example, domestic growth in the US, where growth has been stagnant. We haven't seen growth in domestic the last 2 quarters, which has also drove a lot of the selling, pressure selling on the stock. Now, if we look at the market as well, the running trend is set to continue to grow. More and more people are picking up running, more and more people run. Marathons are actually fully booked months in advance, and HOKA is always there, is always representing, is always advertising in those marathons. And so I think HOKA is very well placed to gain more market share as the running market as a whole is growing. And one thing is for sure, even at economic downturns, people will still need to exercise. Now let's go through the second brand here, which is UGG. And UGG has been positioning extremely well to expand into other product lines. UGG used to be just your slipper, it used to be just, this chunky shoe, but is now entering into new product lines, into clothing, and more importantly, into menswear as well. As you can see, they're using more and more celebrities. They have been in the Paris Fashion Week the last few years, and they are now expanding into new product categories, which means that UGG has been seeing more and more quarter-to-quarter growth, even at quarters that they haven't historically been performing as well. And there are two things that are approaching that could be a big catalyst for the stock. The first one is that Christmas is just around the corner, and also winter is just around the corner. During winter months, UGG is selling more, and I think in the next quarter we will see accelerated quarter-to-quarter growth for UGG as per the historical. And now the second one is, as Christmas is coming, we're gonna see more spending, more Christmas gifts, and that means both an uptick for UGG and also HOKA. Now, Deckers has been growing revenue and expanding margins and growing free cash flow consistently year after year since 2005. We're talking 20 years of consistent growth, of actually delivering results. And this is very rarely seen, especially in companies that are based on trends. And it really shows the ability of the management to execute, to grow brands. And remember, guys, HOKA wasn't a brand up until 2016. This brand has only been in the market and has grown hugely over the last decade, or even less, in the last 7-8 years. And that tells a lot about Deckers Corporation. And for me, one of the most staggering things is the company's ability to grow net income and free cash flow at a higher rate than revenues. As you can see, they have been growing since 2005 at revenue at a 16% CAGR growth, compared to 19% net income growth and 20% free cash flow growth. So that tells us two things. Firstly, the company has not only been growing in revenue, they have been growing in margins as well. Their net income margins have been growing. And also, secondly, the company has an exceptional ability in turning net income, in converting net income into free cash flow. Now, the stock price of the company historically has always tracked free cash flow. And while this has been true for Deckers for the past few years, the story over the last year has shifted, with the stock plummeting while the free cash flow per share and the revenue per share has continued to grow. As you can see, the revenue per share has been consistently growing, and also the free cash flow per share as well has consistently growing, yet the stock price has basically went into a deep dive. Now, one of the catalysts, as I said, for Deckers will be the next quarter, and that is because the third quarter of the year for Deckers is compromised of the Christmas spending and UGG's uptake in revenue because of the winter months. This is what the company reported in free cash flow last year in Q3, and as you can see from the years before. And so I do expect the company to report exceptionally well free cash flow, revenue, and net income results for next quarter. And I think the next quarter will be a very strong catalyst into pushing the stock into levels we haven't seen for a very long time. Now, as of September 30th of this year, the company has a very big approved amount under the stock repurchase program that they have, and that is 2.2 billion worth of shares. That is almost 20% of the company. The buyback yield has been increasing quite rapidly, and I do expect the company to continue to buy stock aggressively, especially at these current prices. Now, in terms of what happened the last quarter and why we've seen the very large dive, Deckers delivered better than expected Q2 earnings results on October 23, yet its shares crashed 15% in the following day session, even though the company's revenue increased 9.1% to 1.4 billion, and while the EPS grew also 14.5% than a year ago quarter, because the management gave guidance of 5.35 billion, which was at the midpoint, which came below analyst estimates, have made investors worry. So essentially, last quarter was an exceptional quarter in my opinion, especially with all the uncertainty, with all the tariffs that have impacted the company. But the management continues to be extremely cautious. They have taken a very cautious stance, especially since earlier this year when the tariff situation unfolded, and this cautious stance is something that Wall Street doesn't like. They prefer to have a bullish stance. But truth be told, I truly believe in the management, and I think that the management is trying to downplay expectations and over-deliver. And I think it's a fair play in the long term. You know, the management is trying to stay grounded into the problems that they have, and they had rather over-deliver and under-promise rather than do the other way. And also, analysts expect and estimate the mean price target for the stock to be $110 in the next 12 months, which is a 33% growth from the current price levels, while street high price target of $157 suggests an ambitious almost 90% upside from the current levels. So even though Wall Street is selling, actually analysts estimate a very large upside from current levels for Deckers, with 10 strong buys, 1 moderate buy, 12 hold, and 2 strong sell ratings. Now, DEC is a return machine, and if you look at return of assets, return of invested capital, return of equity, you can see that the company is just insane. Their return metrics are just increasing year after year, and they're also extremely stable. And this says a lot about a company that is managed extremely well. And honestly, this is an A-star company in terms of financials. The company has no debt, and they're also returning quite well for shareholders. Now, the 3 main problems for the company are the following. The first one is that the company is cyclical, meaning that it's influenced by the economy. Less spending is less revenue for the firm. And with the current uncertainty in the market, everyone is just worrying that Deckers and other consumer-based companies might struggle. However, the truth is that data is showing that apart from the US, internationally, spending has remained strong, especially in Asia Pacific, and this is something that is reflected from Deckers in their financial statements. The second problem is that Wall Street investors only care about tech stocks and AI in the current environment. Anything else, I feel like they just don't even consider at this point in time. There is so much talk around AI that other stocks are just not there. And it really makes you wonder if value investing is that. But in my opinion, we will only know in the long term, and I truly believe, and I still believe in Deckers Corporation. Now, the third problem is, as I said, the CEO and the management remains cautious. Even though they double beat estimates every quarter for the last few years, they lowered guidance to 8% revenue growth for forward year 26, and this spooked investors. Yet, in my opinion, investors have oversold this company. It's now trading at 2 price to sales ratio and 13 P ratio. The CEO, in fact, Stefano Carotti, is an expert in footwear and apparel companies. He assumed the role of the CEO in 2024, and previously he was the chief commercial officer of the company. He has extensive experience in the industry, having senior roles at companies like Puma and Nike. And he has taken a more cautious stance, which maybe investors haven't liked, but I think the guy is incredible. He has so much experience and he definitely has brought value into the firm, and that is something that is reflected very well with the financials, and I think in the future those financials will continue to grow. Now there are three scenarios that I think could play out: the bear, the base, and the bull case scenario. In my base case scenario, I assume revenue growth of 8%, which is in line with what management has been saying. Net income and free cash flow to grow at 10%, because again, historically, the company has been growing net income and free cash flow at a higher rate than revenue, so I expect this to continue to do. And the P ratio of 15. Contrary to that, the bear case is at 6%, 7% net income and free cash flow growth, and a P ratio of 13. And in my bull case scenario, which is very much likely if you think about how the company has performed in the past, at a revenue growth of 10% and net income and free cash flow growth of 13% with a P ratio of 19, which again is less than the historical P ratio. And basically with my base case, I'm saying that revenue will continue to increase from the current 5 billion to 7.3 billion by 2030. Net income will increase from 960 billion to 1.6 billion, and free cash flow to continue to increase from 950 million to 1.6 billion, and profit margins to continue to increase slightly to 22% by 2030, which I believe is all fair. Now, in my base case, with the assumptions I just said, and with the current price, I see a massive margin of safety. With the DCF method, the intrinsic value comes at $178, and with the EPS method at $123, which gives me a margin of safety of 31 to 52%, which is more than my 50% target margin of safety. So at the base case scenario, I see massive upside for this company. Now, if we look at the bear case scenario, I still have margin of safety, which really tells how good of a risk reward play this is, because even at the current price, with the DCF method and the bear case scenario, the intrinsic value is $158, and with the EPS method $107, which gives me a margin of safety of 20 to 46%. And this is my bear case scenario, which I think is unlikely. At the 6% revenue growth, I would be very surprised if the company had this growth in the next 5 years. Now, the bull case scenario is just a completely different picture. And again, I think this is a likely scenario in which the DCF method gives me an intrinsic value of almost $200, and with the EPS method of almost $141, and that gives me almost 60% margin of safety with the DCF method and 40% with the EPS method. So again, very high upside with the bull case scenario. Now, in terms of what I'm doing next and where I think the stock will go, I have bought quite heavily into Deckers. My portfolio currently is very much exposed by movements from Deckers, because a very large part of my portfolio is made out of Deckers, and therefore I won't be looking to add more at this point. My average current price, average cost basis for Deckers is roughly $94. I will be looking to add more if the stock price drops below $80 again. But with that being said, I think the company has tremendous future ahead. I believe in both of their brands, and the company has a share buyback program that they will utilize, as well as no debt at a growing market that they can grab more share. Now, as always, thank you so much for watching. If you're new here, please subscribe, and I'll see you guys in the next one.